Good evening, folks, and welcome to Submyt.com's first ever live stream. Beside me here, we have Ian Jackson. We'll do introductions in a second, but what we really want to cover today is a conversation between myself and Ian, and hopefully some people on the chat will engage around some of the basics around CGT, some of the rules that are intertwined in between them, and then a bit of a demonstration as to how those rules come to real life using the Submyt platform. If anyone's online, we would highly encourage you to get involved in the chat. Don't be shy, ask questions. But before all that, Ian, how are you feeling today?
I'm good, mate. Yeah, I'm looking forward to it. It's been a long time coming. We've spoke about this for a good while, and now with kind of tax deadline and stuff coming up, I think the timing is about right. I think it's probably worth kind of setting a bit of context to start with, which is, whilst we're shooting for RT production quality here, we are on a budget, as in we're in our working offices, we're in houses which are busy. Therefore, there's probably going to be background noise. There's going to be dogs barking. I've got a kitchen not far away from me with a busy household. So excuse all of the noise and the disruptions. We're trying to keep it to a minimum. But I think, fundamentally, it's just us having a conversation, right? I think everybody that's been on this or who is likely to watch this has probably been sat in Zoom meetings and team meetings all week, and you're just bored of that type of presentation style now. We're going to try and stay away from that a little bit more conversational. Yes, there'll be some presentation stuff that we talk about, but we're just going to try and bring this to life a little bit for you in a more kind of engaging and less formal way, shall we say?
Yeah, exactly. A really good point. And I suppose one of the things we're trying to do is for this stream is cover the kind of foundation stuff, the bare basic rules that you need to be aware of. But as we were kind of building out the platform and stuff, and as we've seen clients come on, I think we were surprised that the variety of people that we had coming through the system was quite vast. We have people who receive employee shares, sell them straight away, quite simple to deal with. We have people who do intraday trading, with people who do trading by the minute, by the looks of things. And what it's kind of taught us is that there's quite a wide scope of people out there when you look at the entire market of people who need to file for CGT. And one of the things that myself and Ian talked about from the very get-go, and one of the reasons why we started the Submyt was there's kind of three main areas, right, Ian? Like there's people who actively avoid, people who want to do it, but just it's too much to take on. And let's be honest, it's not exactly the most exciting thing in the world. And then there's folks who go and solicit the help of an accountant or indeed us, like a tax agent.
Yeah, I think, and personally, I've been all three of those, right? When I first got to Ireland, I lived in Ireland for 15 years, as you know, Dave. And all that time was in the fintech. I mean, between us, we actually have nearly 30 years experience in kind of multinationals and, kind of receiving company equity and stuff. And throughout my journey, I would have done all three of those. I would have been the person who went, I only sold a little bit. I'm not going to bother with this. I know there's some kind of allowance. I think I'm under it. It's fine. Just ignore it. It'll be fine. And I've also been the person who knowingly went above that kind of allowance and was like, shit, I need to do something about this. So I'm going to try and figure this out myself. And, very quickly ran into all sorts of complexity and problems and kind of overwhelm and confusion, and was just like, this is way too much. And then, on the end of it, when it kind of solicited the services of a tax professional and paid a massive amount of money to them, which, one of the things you'll get about this live event is we're probably going to run a couple of rants, but, one of them is that both Dave and I have experienced, incorrect, summaries and tax professionals giving incorrect information to us and everything else. So that was kind of part of the motivation behind this. So I think that was kind of what we see is we see all three different layers of people coming on this journey. And I think one of the things that was really important to us, and again coming from my own personal experience, is it's that kind of nagging feeling that you get when you're not compliant, right? You kind of know that it's there, and it's just this kind of thing in the back of your head constantly kind of going, I know I should be doing better than this. I know, right, I'm going to go in, I'm going to learn this stuff, I'm going to be compliant, I'm going to, kind of take this, the bull by the horns and really kind of jump into all this stuff. And, then, but it's just so complex that you kind of end up going, it's just not worth it.
Yeah.
So yeah.
Yeah, I suppose the kind of the crux of it is, and if anyone out there who has an accountant, they're fantastic people. Really, we're not here to bash anybody. But when it comes to your tax affairs, it doesn't matter who you solicit the help of, be it Submit or some Fortune 500 company. It makes no difference. In every single term of service that you have, it's up to you to make sure everything's right. And you're coming from a place where you don't understand. Hence, this is the whole reason why you solicited the service in the first place. And so it was one of the first things I remember. Once I got an accountant, it was just getting too much for me to calculate. And I got the note back saying, "Hey Dave, you owe X, and are you happy with me to proceed?" Yes.
How do you know any different, right? I mean, it's
I
not
don't
like
know
you.
any different, right?
If you do any different, you wouldn't need to go to him in the first place, right? If you knew what the final number was, so you wouldn't need that service
Exactly.
in the first place, right?
Yeah, exactly. Sorry, Jim, you forgot to carry the one. No, I'm not going to look at it from that perspective. I've no idea how the foreign exchange side of things worked, or with deferred losses, any of that stuff. I had no idea at the time. And so, yeah, that's the tricky part of it, and that kind of raises the anxiety and fear. So, like, the point we're trying to make throughout all of this is, it ain't that hard to be compliant. The hard part is the calculations and the physical effort of trying to track stuff and all of that piece. But it can be done. A quick example now, for somebody who works in a company that they just buy employee shares in and they sell them immediately as soon as they receive them. This becomes very simple from a calculation standpoint, so long as you always sell them immediately. It's where you start layering in higher velocity of shares, like, so you have maybe multiple stuff, like RSUs, and then you maybe dabble in the crypto markets or the stock market yourself. That's where more of these tax rules come into play. But a lot of people can get away with self-filing. In fact, it's one of the things we encourage. We push people towards our cheapest product purely because we think for the vast majority of people out there, there's 750,000 people in Ireland who have to pay CGT each year. And we think the vast majority of them can self-serve. And that's what the scope of this conversation is going to be today, is just what are the fundamental rules that you need to know when it comes to CGT. And again, with a bit of a product demo and a few rants in between it with some dogs barking and things like that. Full disclosure, you might see this door open behind me as well. One of my dogs knows how to open the door. So if we see a visitor, sorry, but that's life.
If one of your dogs comes up, I reckon that's going to be the chance of increasing their ratings. You
Yes.
kind of get there. You go down the route of the dog lover who just happens to rescue them from a husky home and all this type of stuff, and the ratings go up, right? So you appeal to the masses that day.
That's it.
I think just to kind of summarize what we've kind of said so far, I think what we're really on about here, what we're trying to help with, is just kind of empowering people to take responsibility of their own tax affairs. It is simple. It is simple enough to do, to give you the confidence to do this. There is some complications around the calculations. We're not going to lie; it does get complex. Although we're going to try and keep that we're going to try and dumb it down as much as we can today for you. But the good news is, obviously, we have the solution just on the platform side, I think, to help with the calculations if you need it. But all the rest of the stuff, we want people walking out of this going, "Yeah, I've got this. I understand this now. I can be responsible for this going forward, and I feel good about the fact that I'm taking responsibility for my financial affairs." So that's the nuts and bolts of it. Dave, do you want to maybe quick overview of what we're going to cover today?
Yeah, so in essence, we're going to look at CGT 101, some of the core dates that you need to be aware of, and we're doing it from a timeline of today onward. How those core dates interplay with each other, how stocks and crypto are kind of treated from a CGT perspective. We're going to look at FIFO rule. We're going to look at a bit of wash selling, 28-day matching rule, and all important foreign exchange rates and how they impact in a very simplified way, in a sense of, we'll keep it as easily understandable as possible. And then Ian will take us through the Submyt platform and how some of those rules interact in a more real scenario. So in other words, put real stocks into the system and show you how it plays out. and how it kind of helps with that understanding of how that particular trade was treated from a CGT perspective. And then I think we'd be pretty much out of time at that. And we'll just do a quick wrap and finish up. But I suppose if you can't stay for the whole thing, obviously, of course, not a problem. This is being recorded, so we will, after we bleep out some of the curse words and so on, we'll post it onto the channel and so on. But before I get into the deck itself, on YouTube, we do have a lot of how-to videos. We're building that library up as much as we can. So if you are stuck and you know this stuff inside out already, you're just, oh God, this is boring, but you're stuck on how to fill in a CG1 form, we have resources there for you to have a look at and make it as simple as possible. So yeah, that's what we're going to go through today.
I think the only thing then, just to kind of add on to that, is going to be, obviously we're conscious that there are different types of people that interact with this stuff, or this affects, right? So, we want to, for the equity-based compensation, people that work in, large multinationals and receive RSUs, ESPPs, that's its own kind of really nuanced thing, which I think confuses a lot of people. Not these tax professionals. We've seen a lot of examples of people struggling with this, and again, not necessarily from a understanding the rules standpoint, but from a calculation standpoint. So I just want to kind of talk a little bit about that, from given that we have that background in the industry, to talk a little bit about that from a share identification and how that works within your company share schemes. But then obviously, as we're talking through that, a lot of that then still applies to somebody who's on Revolut, Trader 212, just buying a little bit of the Mag 7, or somebody who's doing a bit of Bitcoin trading on Coinbase and that type of stuff. Now, crypto does get really complex, particularly if you're a proper degen, and we're not going to go right into the weeds here, but we can talk to it at a very high level what that looks like. That's generally the goal and what we're aiming to achieve today. So, do we get into it?
That's
right. So I'm driving, by the way. So if we transition to one scene and we're showing something wrong, then it's all on me. You can blame me. So, right, hopefully this is the right scene. Dave, take it away.
So, first, in order to understand some of the rules and all that kind of stuff, the best place we figure to start with is, well, what's coming up? Okay, so from a timeline perspective, today's October 1st, 2025. These are the 3 key dates that are coming up. So October 31st, 2025 is the next filing deadline for anything that you sold in 2024. And we'll talk about that in a little bit in a second. The next key date for anybody who owes CGT is December 15th. And that is for any stocks or assets that you sold between January and November this year. And it's a little bit backward. So I'll say that again. October 31st, 2025, coming up in the 30 odd days, is for you to report on all your CGT from 2024 sales. December 15th is when you're going to be paying your CGT for assets you sold this year. And then January 31st is our next core date. That's January 31st, 2026. And that's going to be for the December sales coming up. So anything you sell this December, the CGT is due in January of next year. And so how does that look? So if we take an example of 2025 sales, anything that we sold between now and up to November 30th, 2025, we must pay the CGT by 15th of December, 2025. In other words, you've got 2 weeks to pay by the end of the period. And that's what we call period 1. Period 2 is all of December, and that has to be paid by the end of January following that December. And then you come all the way around the clock again to 31st of October, 2026, and that's when you tell the government by filing via CG1 or Form 11 what you did in 2025.
But Dave, just to jump in on that,
yes,
you can file anywhere from, say, January through to October, right? It's just that it has to be done at latest by October 31st. So if you're good to go on January 15th, you could do your filing for the previous year on early January.
So long as the relevant form has been made available by Revenue, yes, you can. So Revenue will update the CG1 form each year. It may not be by January 15th, but it'll be once it's released, you can file. Yeah, absolutely. There's no penalty. In fact, it can be a benefit to you, especially if you're unsure. I know revenue sound like a big scary department. They're not, believe me. I talk to them a lot. They're very, very, very helpful. And when you think about it, you're trying to pay taxes, right? So if you are stuck with how to fill in a form and we didn't cover it in the YouTube video and you need it now because you're going on holidays or what have you, give them a call. Genuine, don't do my inquiry, call them. It's much easier and quicker. You do genuinely get through quite quickly. And they do aim to be really helpful, and they can assist you, I believe, up to the end of July. They'll have more time to give to you on the phone to help you through with calculations and stuff like that. So yeah, absolutely. There's no benefit in waiting until the 31st of October. Yeah, you're absolutely right. So then when we talk about rates and the actual euro amounts, for what we're talking about today, which is basically stocks and crypto, it's going to be 33% is the capital gains tax rate on any gains that you made. So if I bought something for 1,000, for 700, I sold it for 1,000 and I made 300 euro, assuming there's no exemptions or losses or any other that stuff, that's just pure raw profit, I owe 100 euro in CGT, 33% of my gain. Now, the good news is we get an exemption, even though it's tiny, but we do get an exemption of 1,270 euro. So in that previous example I just said, where we had 100 euro gain total for the year, the exemption wipes it out. So we don't owe anything. But one really important thing when it comes to capital gains tax is even if we don't owe CGT, you still need to file. If you made a loss, we really encourage you to file, because the good news with losses is if you made a net loss in 2024, say 1,000 euro loss, if you file, you can use that loss later on, and it goes on indefinitely. So if you have 5 years where you're losing 1,000 euro a year, you can carry those forward. And then in year 6, if you were to make 10 grand, you can take that money and straight away take it off the 10K gain. And then you also get your exemption for that year as well. The thing with exemptions, they don't carry forward. You don't use them, you lose them each year. They can't be transferred. So your exemption is a personal exemption that can only be used within the tax year itself. Then when it comes to filing is quite simple. For the vast majority of people, you will get away with what's called a CG1 form. A CG1 form can be downloaded from the Revenue's website. A few of our YouTube videos have links to Revenue's portal where you can download them. And we have instructions and tutorials, like we mentioned before, as to how to fill them in. CG1s are generally for people who are PAYE earners who don't need to fill in what's called a Form 11. So in other words, you're not what's called a chargeable person. And that's getting a bit technical. But for the vast majority of people, where most of us are PAYE workers and we don't have a second income that we're charged separately, a CG1 form will do. You can still do a CG1 form even if you are a chargeable person, but you're doing 2 forms for the sake of the same thing. It doesn't make any sense. A Form 11 would be used to file your CGT, and this is getting quite a bit advanced in the sense that that's an income tax return that has CGT tied onto it. It's the exact same format as a CG1 form, but they're just 2 different ways of telling the government by the 31st of October how you made your gains. That's all there is to that. Ian, anything you want to add to that slide before we move on?
No, I think just the key things to reiterate there is vast majority of people, CG1 is absolutely fine. Once you know your numbers, and we're obviously going to help you calculate those if you want to do them yourself, or we obviously have a solution here as well if you want to do it. But CG1 is a relatively straightforward process, and it's something that the vast majority of people should be able to do themselves if it's applicable to them. I think it's worth calling out, David, just before we move on, because I know that we have an asterisk against the CGT rate of 33%. You just want to cover the one exception, just so that we're being, certainly around stocks and trading and stuff, just so that we're being.
Yeah. So there's lots of exceptions, right? This is capital gains tax. So some stocks, when you buy them, come with what's called a dividend, and a dividend is basically the company rewards you with cash money for owning the stock. Apple would be one of the more commonly known ones. Microsoft as well, I believe, pay a dividend. And so if you're in receipt of company shares, for example, you hold those shares, you will receive dividends as well, and they're taxed at income level. They're not capital gains taxed. So that's an extra income that you're making that you'd need to confirm with the government come October 31st. Now that could be done when it comes to income. There's other ways of doing it. We won't touch that here. I suppose Cliff Notes, Form 12 or Form 11 will do it. But the other one from a CGT perspective, where rates are different, would be on funds, and they can vary depending on where the fund lives, but typically they're in the 40 percentile. So they're more expensive than the 33% CGT rate, and there's complexities in there when it comes to funds. Like there's a thing called deemed disposal. So if I buy into the S&P 500 for €1,000 and I keep it for 8 years, and that by year 8 it's worth €1,200, the government will say, even though I haven't sold anything, government will say, you owe us capital gains tax on that gain already, and so I have to pay the tax before I've even realized the benefit, which is crazy, extremely controversial in the investment circles, something we should have done away with a long time ago. Ian, I'm at risk of going into a rant, so I think we'll move on.
but just the other way that people may have heard the word funds, just because there's different kind of terminology being thrown around. This, Dave, is ETFs, right? So if you're investing in ETFs, there is a slight different rate, 41% that's applicable on ETFs. Now, full disclosure, from a Submit standpoint, we don't have ETFs built in yet. It is on our roadmap. So if you're an ETF user, then it's something that we were going to hope to help you out with sooner rather than later. But for the vast majority of people, I mean, it's not that, because of the complexity Dave was talking about, it's not that much of a popular instrument now anyway. So hopefully that doesn't apply to many people, but it was worth calling out at this point. Okay, so I think we covered 101. And if anybody wants to ask any questions and you're with us live, then feel free to add them into the chat. But similarly, after the video, when we put it back up, add it in the comments. One thing that we want to do after these videos is kind of get a sense of where people are still confused, and maybe we can then do further deep dives on that type of stuff as well. So if any of that doesn't make sense to you, by all means, add a comment or in the chat now, and we'll get to cover it and give you the information as is needed.
Yep, and slides will be made available as well, and all that kind of stuff. Like I said, we're doing a recording, so if you want them for reference, that's no problem at all. Or shoot us an email at support@submyt.com, and we'll fire them off to you. Okay, so buying and selling. So our brains work in a very simple way. We bought something for 700, we sold something for 1,000, we made 300 quid. We made a gain. Way hey, great. The problem is when we talk later about the tax rules, it isn't often that simple. Now, it's not helped that the systems that support trading aren't really good. They're built to be intuitive. They're not built for the Irish tax rules. So you might be an employee who receives restricted stock units. You buy into the ESPP program. They have performance stock units. You dabble in stocks yourself. Like Ian said earlier on, you might invest in the Mag 7. Or you go for crypto. This all layers in that complexity we talked about earlier on. So the easiest thing to do when it comes to even beginning to think about trying to do this yourself is you break everything down into two things. It's acquisitions and your sales. So acquisition events. Let's say, for example, we had a restricted stock unit that vested on the January 2025, and we acquired 30 shares. In ESPP, May 2025, we acquired 40 shares. We now have 70 shares. And we have ordinary shares written there because generally when you are in receipt of stocks, say you're trading on Trading 212 and you're buying Microsoft on the New York Stock Exchange. Different versions of Microsoft exist. They're on the CAC, they're on the Frankfurt Exchange, they're in the London Stock Exchange. They are in all likelihood different from those New York Stock Exchange shares, which is MSFT, I think. But if you are buying shares into your company, you are just amalgamating the same share type in the same company. So when we think about employee shares, vesting is an acquisition event. And the big difference here with employee shares is people get confused by the grant and the vest. So really quickly, a grant is a promise to give you something so long as conditions are met. So if we were to think about restricted stock units, I'll grant you 900 shares and I'll give them to you in thirds over the next 3 years, so long as you're still with the company. And that's a very simple condition that most of these RSUs go by. To layer onto that, if you think about performance stock units, they vary, right? There might be more conditions to them. It's like, I promise next year I'll give you 500 shares if you're still here, if you perform to a certain level that I expect, and if the company performs to a certain level we want it to reach, okay? And so there's more conditions to it, and they often come with consequences or benefits. So if the company doesn't get there, but you were fantastic, it might drop the amount that we give you. But if everything's fantastic, we might double what we give you. And so this is why you might see some variance when it comes to performance stocks. The fundamental thing I'm trying to get through to you here is a grant is just a promise that something good, because it's always good when you're getting something for nothing, although blood, sweat, and tears go into it from your work when it comes to RSUs and ESPPs and PSUs. But it's a promise to give you something. The vesting is an acquisition event, and the day it vests is the day you got something. And it's just really important to burrow into your head when it comes to employee shares. And then we have disposal events. It's a fancy word for saying we sold something. Okay. The way in which a share was acquired does not matter in the eyes of revenue. You, in the example above, have 70 ordinary shares. If you sell 15 shares, you just sold 15 of something, of a pool that you own in the eyes of revenue. They don't care if it was an RSU, if it was an ESPP, PSU, or you went and bought more of your own company stocks in the market yourself outside of employee plans and so on. It's just a big pool of stock that you have that you're minusing your ownership of as you sell them out. Ian, anything you want to add to this one?
No, I think you covered it. I think you covered it right. I think that was just a lot of confusion that we see, and we'll get into examples of this later on. But somebody will typically go onto their trading platform. So I mean, both Dave and I worked in PayPal, so we would have used, as PayPal employees, E-Trade was our platform that PayPal used. So we would go onto E-Trade and we would sell our ESPP, for instance. And on E-Trade, it looks as though I've just sold those shares, and the gain is just based on, the what I bought those ESPPs from, what I sold them at. But in reality, that gets a lot more complicated, potentially, depending on, we'll go through some of those rules in a minute, because ultimately the way that they look at it is that it's just an acquisition event, whether it's ESPP, RSUs, or PSUs. It is just the acquiring of shares, and then we talk about the sale of shares afterwards. So even though your platform says whatever the mechanism of acquisition is, you almost have to forget that once it comes to actually calculating your gains. Forget what the mechanism was and talk about how many shares do I got, what was the cost of those, and then how many shares did I sell. And that's the fundamental piece that I think confuses a lot of people.
Yeah, exactly. So let's get into the rules then. So the first one we're going to talk about is, I suppose, the foundation level in which revenue wants you to calculate your stocks. And that's FIFO. And that stands for first in, first out rule. We'll go through an example in a moment, but fundamentally revenue wants us to, but revenue dictates when we sell an asset, we consider the first asset we ever purchased to be the one that's sold first. So to go back to what Ian said, you can have RSUs, ESPPs, PSUs, all this kind of stuff. Revenue don't care. If you sold 10 shares of our 70 that we talked about earlier on, it considers the first batch of assets that we acquired and where they're still there to be sold, and when we're working out what we gained. And I know this will trip up a lot of people. So we'll go through the example now so we can try and gain some understanding on it. But it applies to shares of the same type. Like I mentioned earlier on, if you bought or received company shares in Microsoft through ESPP, PSUs, RSUs, buying them yourself on the stock market, they don't care if it's the same Microsoft ordinary shares that are traded on New York Stock Exchange. Revenue don't care. It's the same thing, same asset. Like I said, the caveat being, there are some differences. If you buy them on a different exchange, like the London Stock Exchange, in all likelihood, it's a different asset class. different type of Microsoft stock, so they're separated generally, but check first. So in our example, when we refer to PPS, we are talking about price per share. We're going to have our totals up here, and in January 2025, we acquired 30 shares. Price per share was 100. We're not doing currency right now, so we're just referring to, let's call it 100 euros, doesn't matter, totaling 3,000 euros. Then in May 2025, we acquired 40 shares. The price per share was 125 per share, euros, and that totaled 5,000 euros. So we've now about 8,000 euros worth of acquisition value total. And then in August, we sold 40 shares at 150. This stock is going gangbusters, right? It's seen a huge increase over the course of the year. And we sold those 40 shares for 6,000 euros. Now, what normally people do is they'll see the August 2025 40 shares, they go into, let's say, E-Trade, and they go, okay, do you know what? I could do it $6,000 right now. I'm going to sell this batch. And we're going to say, oh, well, it cost me 125 down here, and I sold them for 150. So surely that's how I calculate it. Unfortunately, it's not how you calculate in this case. Revenue want us to look at it from a FIFO perspective. So same thing, we sold our 40 shares for 150 a share, totaling 6,000 euros. The first shares we acquired are considered to be sold first. So these 30 shares at 100 per share need to be considered first. And they cost 3,000 euros, remember? And where do we make up the remaining 10? This is only 30 shares, we sold 40. Well, revenue want us to pick those 10 out of these 40 at 125, totaling 1,250. And you'll see how much this can change our gain. It's 1,750. So it's quite a difference in terms of how it works. One side of it, there's no taxable gain at all if this is all we sell in the year. And the other side, there is a taxable gain. Even when we minus off the allowance, there's a taxable gain to be had. That's how revenue dictate how we are supposed to work our cost basis, as we call it. There are there's a few exceptions, and we're going to go through them in a moment. For example, if you sold the shares as soon as you got them in May, things would be different. But if you are the type of person that holds company shares, or you buy for the longer period of time, or you slowly gather shares as price fluctuates, moves up or moves down, cost-based averaging, is call it, this will most likely apply to you. So yeah.
I think just to kind of reiterate, I suppose, even though this is a very, very simple example, which brings it to life, already you can start to see the complexities in trying to do this yourself within a spreadsheet, because now you've got to take that 40 shares that you sold in May and kind of withhold 30 from that. So when you sell your next event, then you know that you've got to kind of then tap the remaining 30 from the 40 that you originally acquired. So kind of tracking that throughout an Excel spreadsheet gets really, really complex. And this is why, and again, this is a super simple example, but this is why you see a lot of people really struggle with this. You see, we experienced ourselves incorrect calculations, even with tax professionals. And again, nothing against tax professionals. This stuff gets really, really hard to do in Excel when you have this kind of more complex trading history.
It's from the accountants that we spoke to, it's not a very popular client acquisition for them. They don't like doing it because it's a big time suck to try and work this stuff out. I suppose to add to that, what we noticed as we were in industry was that vesting periods, especially around employee stocks, and apologies to anybody who's not here to talk about employee stocks, but it is where our specialty sits, I suppose. One of the things we saw is the frequency of vesting periods was getting much higher. So 12 years ago, when you got an RSU, it was one vesting period every year, right? So I get something in 2025, I get a third in 26, third in 27, and a third in 28. That all seemed to be changing. It was, okay, you wait a year, we'll give you a third, and then we'll give you a batch every quarter until it's all gone by the end of year 3. And so why is that a problem? when you have all these multiple vesting periods, if you're not selling them immediately, FIFO kicks in and it increases that frequency we talked about earlier on. This is really simple if you just buy, in May, you buy a load of stocks and you sell them in June. The CGT is really easy for you. You don't have to worry about it. If you're buying and selling everything within a certain amount of period of time, it's grand. It's easy to do. But and this isn't your fault either, you can't. A lot of companies won't let you say no to the grant if you're still with the company, right? So you're kind of forced down this path to a certain degree, and that's why it's really important to understand FIFO as well and the other rules that we're about to talk about now. So I suppose let's get into it. So the next one is called the 28-day matching rule. Now, to set the scene, when you sell within 28 days of buying a stock, this gets matched to that purchase. And this is the one exception to FIFO. It's very common in employee stocks. We've already seen it at a client level. I used to do it with the performance stocks when I was working in PayPal. As soon as those babies released to me, give them to me straight away. I'd sell them immediately. So yeah, then this is not wash selling, which we'll talk about later on. It's the opposite flow. So a lot of people confuse 28-day matching with wash selling, myself included when I'm tired. It's a flow of buy then sell rather than sell then rebuy. So let's talk about 28-day matching from an example perspective. Again, PPS is a price per share, totals are total, and we're still dealing in euros here.
I think just Dave, just one thing quickly, just to jump in there. I think, obviously we're talking here a lot about employee equity and equity-based compensation. But, if you were almost like day trading, Revolut, trading 212 and that type of stuff, and you're kind of you're buying and selling stuff at a relatively short interval, you're more than likely going to be talking about this particular scenario. More so than running into the rules around FIFO and that type of stuff. So if you're just doing kind of casual stock trading, generally it's going to be this one, unless you're holding for longer than 28 days. And that's the key piece in terms of how long you hold it before you sell it as to which rule gets applied.
Yep, exactly. It's not just, none of these rules are just for employee stocks versus everything else, like intraday trading and stuff like that. It's a holistic approach to how revenue look at things, and it can affect multiple types of investor out there. Absolutely. So when we look at our RSU, we got in January 2012, we acquired 30 shares. Price per share was 80, totaling 2,400 euros. We had an ESPP vest in May of 2025, acquiring 40 shares. We got a sweetheart deal with our ESPP. It's considerably under the market value, and that cost us 2,000. Then, as soon as those ESPPs vested to us, we sold them straight away. We wanted to get them out of there. But the real market value on the day was 90 euros per share. And so we made 1,600, but it's 3,600 was the sale. Now, how did that work? Well, put simply, because of the 28-day matching rule, when we received those ESPPs in May and we immediately sold them, revenue looked at it as being a short-term sell, and therefore we apply a terminology called LIFO, last in, first out. And so under revenues rules, we must take the ESPP shares, we ignore the RSU, it's got nothing to do with this transaction because we sold these ESPPs within 28 days of receiving them. Now, for those who might be confused about the pricing, ESPPs are contracts where you agree to buy a share at a certain price with perhaps a certain discount over a certain period of time. Hence why you'd often find if a company's share performance is doing really, really well, you might see that the price is quite low compared to the actual rate on the day that you received them. So just to give a bit of context behind that. So yeah, the ESPP is matched in this case, completely ignoring FIFO, and it's known as LIFO, first in, first out. So to reiterate what Ian said, regardless of if it's employee stock or trading stock markets or within crypto space, all this kind of stuff, if you bought an asset and sold that asset within 28 days, you're going to be matching that like for like, ignoring everything I talked about in the previous slide. Okay. So now we get into wash selling. You might see people Googling this or you see it on Reddit forums. This is known as the bed and breakfast rule.
But then can I just jump in just super quickly? So before we get into wash selling, because I think one thing that to kind of understand, wash selling is a very nuanced kind of rule.
It is extremely, yeah.
What we have spoke about so far in terms of our FIFO and our LIFO, or the 28-day matching rules, that what we're talking about there is basically how you allocate the shares that you have to the sale of the shares that you're just about to make. So we're talking very much, kind of acquisition and disposal events within that context.
Yeah.
So that's kind of that, and that is it in a nutshell. That is that entire kind of thing in terms of how we allocate the shares to a particular disposal and make sure that we're capturing that through. Wash selling, we do get into kind of shares and some more nuances there, but that doesn't impact anything what we've seen before. You still apply FIFO and LIFO. Are basically the only two scenarios in which you calculate your cost basis. Wash selling and the bed and breakfast rule that we're going to talk to now is a separate thing, which kind of kicks in a very specific scenario, which Dave will talk about now.
Yeah, it's a little bit more complex, but bed and breakfast rule, also wash selling, is when you sell at a loss to rebuy the asset within 28 days. So when you go to sell that newly purchased asset, the loss, if any, is there, is tied to that newly purchased asset, known as the rebuy. And that's known as deferred losses. So who does this? Say you don't want to pay tax. It's coming up towards the end of November. Yeah, I know, right? Coming up towards the end of November, and you've calculated on your spreadsheets, or you can see through Submyt or whatever mechanism you use, that you're going to have to pay revenue €1,000 in capital gains tax after losses and all that other stuff. And then you go into your trading platform and you say, hey, do you know what? I have some absolute dog of a stock that's not doing well. If I dump that now, I think it'll make money next year. If I dump that now and buy it straight away again, I think that would be a good idea. And this, I suppose,
and the purpose of that is that you're going to take that loss when selling that particular thing is to offset the gains that you've had throughout the course of the year, so that you have zero output or zero liability to revenue within that.
Exactly. But if you repurchase that asset that you've now sold deliberately at a loss, it gets tied to that repurchase. In other words, you can't use it to offset your gains for the year so far. It gets tied to the repurchase. And so if the stock moves up substantially in a day or two, fabulous, well done, go you. But that's unlikely to happen in the markets. It's more likely to happen later on down the road. And so the loss is tied to that repurchase. So let's have a quick look. So in May 2025, you acquired 40 shares, cost you 100 per share, €4,000 in total. August 2025, 40 shares at 90, €3,600 total. You sold them at a loss of €400. Then the same day, same minute, you bought those 90 shares back at a cost of €3,600. Okay, well, what's happened? Let's go through two scenarios as to what can happen, because those reacquired shares in August, the ones in teal, are now fixed to the loss that we see above it, right? We can't use that €400 to offset other gains within our trading throughout the year. So in December 2025, the share price lifts. It's now worth €4,200. It's a €600 gain. The 400 loss that we have incurred can be used to offset against that specific sell event, only that one, leaving €200 subject to capital gains. So to quickly go over that again, the numbers in red are the original trade where we realized a loss of €400. We then sneakily went in and rebought those shares for 3,600, thinking it's going to go up. I guarantee it's going to go up. Sure enough, it did in December 25, where we sold the whole pot for 4,200 with a €600 gain. The 400 that we specifically realized that loss is now taken from that 600, leaving us with €200 capital gains tax, which, if you're paying attention at the very start, we need to pay by January 31st, 2026. Let's go with another scenario where the price lifted but didn't lift as much. So €100 price per share, totaling 4,000, a €400 loss, or gain rather, sorry. The original loss of minus 400 fully offsets that gain. Okay, so it's like nothing ever happened. We, in fact, bought them for 4,000, sold them for 4,000 if you go to May 25 to December 25. So basically, it offsets the whole thing. And so that's how the deferred losses platform works when you reacquire the shares. Now, I suppose one important thing that we should have probably said at the start of this, Ian, we're not accountants or financial advisors, right? We're just very, very in tune with how this stuff works. And we are TAIN registered and all that proper stuff and past all that stuff. But one thing we can't do is give advice. But where the difference is, like, so we can't help you with your tax strategies or should you buy or should you sell. We can't do any of that stuff, and we won't. It's not ethical for us to do that. We're not in the trading markets that deep, right? So what's the difference here, and why is it a deferred loss rather than wash down? Well, it's a deferred loss because we rebought within 28 days. For somebody to wash sell, to realize that loss deliberately, they need to wait those 28 days before they rebuy. So say, for example, those 40 shares were reacquired in October. Well, then none of this comes to fruition, right? That's just realized as it normally is in the tax system. It's nothing to do with any of this stuff. So it's all key around the 28 days as to what activity happens. That's just a really important note to point out. Once that rebuy occurs, the 28 days thing, you forget about it. It's deferred loss now, and it's tied to that next sale event in December 2025, as represented here. Ian, I know this is really complicated, so context or any thoughts?
Yeah, a couple of things. So number one, I think the first important thing to recognize here is that, yes, this is another 28-day event, but this is a very separate 28 days. Unfortunately, it makes it a little bit more confusing, just at the same time frame as the LIFO that we were talking about before. But these are very different kind of scenarios that we're talking about. I think, the idea around the bed and breakfast thing is really to kind of prevent that wash selling activity. Now, I mean, people want to engage in that themselves, and that's their decision to do so. But that's kind of really the idea and the incentive behind it, is to prevent that kind of, I think it's called loss harvesting, Dave, if I'm not mistaken.
Yeah.
I want to realize this loss, and I'm going to rebuy, and and everything's fine with the work. So I want to offset. I want to reduce my tax bill. So this exists to prevent that activity, or to de-incentivize that activity. I think whilst this sounds really complicated, I think this is really, really important, particularly, a common theme throughout today's conversation is people who receive equity-based compensation. What we're talking about now feels like on the surface, some kind of professional trader type strategy, and that's, I don't have to worry about it. This is where this gets really complex and confusing for people, is that, and again, go back to what we spoke about before, the fact that an RSU, an ESPP, a PSU are basically irrelevant, right? They are just acquisition events. What can happen, and given what Dave was talking about before in terms of the frequency of vesting and stuff like that increasing, if you go and sell, say you receive some RSUs in March, that was one of the old schedules that we would have had, and the share price drops, and I go and sell it at a loss in, say, mid-May, typically what happens, and again, this is just, within what we're used to, the rhythm that we're talking about, my ESPP used to vest at the end of May. So even though, we're talking RSUs and ESPPs and all this type of stuff, that organic acquisition of ESPP at the end of May, the loss, that is now the reacquisition event of the loss that you sold of the RSUs in mid-May. So this does apply to you. You're not intentionally doing it from a loss harvesting standpoint, but just by the nature of selling some shares at a loss, receiving some as a vest later on, or buying it back, even though you don't control the timelines of that, this still applies to you. So this is where it kind of gets a little bit more kind of complex, and people have to be mindful of the fact that whilst this, as I say, does seem like a kind of professional trading strategy, it can inadvertently hit everyday people just going about their business and receiving some property shares.
Yep, Absolutely. There's not one sector that we're focusing on here, from employee shares to cryptos or whatever. All of these rules can and do apply to everybody who's buying in these areas. So, yeah. Well said, Ian. Thank you. All right. And then on to currency. So, we do have a story around currency, but I think we'll skip it in the interest of time. Currency is easy, right? But it's annoying. But it can greatly affect the cost and sales, right, of your assets. It must be accounted for. We go right back to this to the second slide. Everything's broken down into acquisitions and disposals, purchases and sales, whatever you want to call them. The currency needs to be factored. Some platforms do it for you, most don't. So the world's largest markets aren't EU based. Yes, the CAC is huge and Frankfurt's big and all that kind of stuff, but they don't hold a candle to the New York Stock Exchange. London Stock Exchange is in the pound sterling. So a lot of the world's largest markets don't sit there. Or maybe you invest in something more nuanced. I like energy stocks. Most of them are in Canada or Australia. So, that's the way it is. Most people typically, if we go back to the simplification of how we think this stuff works, batch selling, at event rather than event level, we batch sell at title level, right? ESPP, I sold that, it cost that, and that's how much I made. Most people apply the same thing to currency. They only apply to the currency when it comes to the actual sale itself. So we will throw up a link as well to the official approved exchange rates, which is the European Central Bank exchange rates. Really quickly, I can show you on the tab. ECB, you just click on 2016, download the file and have a quick look. It will give you the rates for every single day all the way back to 2016. And that's what you're going to use as your index when you're calculating this stuff. So let's throw in an example. Again, we've price per share, the foreign exchange rate, the foreign exchange adjusted rate, and the total. And let's just say, for argument's sake, this line here is going to be in US dollars, and this line here will be back into euros. So we're also using the same example as we used in the FIFO example, where we had that gain of 1,750. Nothing's going to change in terms of that arithmetic as well. So if you're looking at this on a recording, go back to the FIFO slide and you'll see what it is. So January 2025, we acquired 30 shares, $100 per share. The foreign exchange rate on that day, as approved by the ECB, was 90.90, which meant in euros, it was 90 euros per share, totaling 2,700 euros. All of these numbers are fictitious and made up, guys. It's just to make it simple for everybody to follow. May 2025, you acquired 40 shares. The price per share in US dollars was 125 US dollars. The foreign exchange rate moved a little bit, well, quite a bit, to 0.8. Therefore, our price per share was 100 euros per share, totaling 4,000. August 2025, we sold those 40 shares. If you remember, originally we sold them for 6,000. Let's call it now US dollars, 150. But the exchange rate is the same as it was in May 2025. The price per share is now 120 euros per share, totaling 4,800 euros. So the incorrect way of doing it, like we talked about on the left side here, most people only apply this to the day they sold. The gain, originally as we calculated, was 1,750 US dollars. We took the August foreign exchange rate, which is this one, 0.8, and that adjusted gain is 1,400 euros. This is wrong. The way we should be doing it is we sold our 40 for 4,800 euros. Then we take, remember FIFO, we take our first 30 shares, that's 2,700 euro because it was 90 euro per share. And then the 10 from May 2025 with 1,000. And you'll see that there's a difference here. That's quite substantial. Because of the market, the currency fluctuations over the course of that buying and selling event, the gain reduced significantly. So in this particular example, you've made yourself liable for CGT that you actually never owed, right? And just to hammer home the point, that's a 27% difference. And again, this is an extreme example, but 2022, the US dollar did move by about 15-20% against the euro by the course of the year. There was a point where you were getting it broke below parity. So currencies do move, they do matter. They don't often move wildly, but they do shift about, especially for people who hold a bit longer term. Currency really does make a big impact. So something that you need to be very cognizant of as you're doing these calculations. And again, I suppose to bring it all home to one piece, remember it's all at acquisition level and all at disposal level. The currencies need to be adjusted for each one. And why I said at the start why it's a bit of a pain is if you've lots of acquisition events or lots of disposal events, you need to do it for each one of those. And you need to go against the index table from the ECB to make sure that you have the correct rate applied. Now, there's macros and stuff like that that can do it in Excel for you. But again, it's just another layer of complexity that, again, is affected by the amount of trading that you actually do. So I'll give you a really simple example of my own personal learning. A few years ago, I started copy trading on a platform called eToro. And I wasn't prepared for the volume of shares that this would be transacting. And it's gargantuan, like thousands and thousands a year. And that means I have to go in and look at each single acquisition piece and make sure that it's all converted back into euros for me. And yeah, so I stopped copy trading very quickly. Wasn't even making money. But that's currency in a nutshell. Ian, anything you want to add to it?
No, really, I think you covered it. I think, it just, I suppose, hammering home the point around the making sure the accuracy of how you calculate your cost basis and how you calculate your gains is vitally important. Whether it is on stock trading or whether you are in receipt of equity shares or whatever that looks like, if they're non-euro assets, you have to do this stuff right? And it's the only way to make sure that you're not going to get bitten on the arse later down the line. And actually, I know, Dave, this was one of the challenges that you had with your particular. We won't go down your own individual rant, but this was one of the challenges that you had with your example with your tax professional, where they didn't go in and do all this work. You would have paid them for the hourly rate as if they had done, but they basically just broad stroked and put an annual FX rate across every single trade, which fundamentally is incorrect. I mean, I understand it from their perspective to save them hours and hours and hours of time, but Dave's CGT calculations as filed by them were inaccurate.
And wildly inaccurate because of foreign exchange rates. Because that year, most of my trading would have been between US dollar, Canadian dollar, and Australian dollar. The vast majority of that would have been in the US dollar. That was 2021, I believe, where I discovered it. So it could have been trading year 2020 or 2019. I can't remember. The currency market fluctuated by 15% that year. So I could have left thousands of euros on the table that I could have quite rightfully kept. That went back, it was corrected, and it turned out it wasn't that much, unfortunately. But there was a bit of a refund. There was a bit of a refund. It was a couple of £100, and I'd rather it be in my pocket than the government's, right? Who doesn't feel that way? So so it worked out in my favor. Now it can also, like anything we've talked about so far, it can also work against you in terms of what your chargeable gain actually is. But I suppose the really, really important thing is you can walk away from this confident that you have the right numbers in with revenue and that you're sure that it's all good and compliant. And that's fundamentally what we're trying to do here.
Yep. Okay, so I think there's a lot of theory there. Probably went on a little bit longer than we expected.
Practical.
I think
we need a practical.
We need to get into the practical.
We were worried that we weren't going to have enough content for the time that we had. So there you go.
Have we ever got on a rant or anything?
We don't have time for rants. I was very tempted. 2 times I've been very tempted to go on a big old rant, but no.
Right. Okay. So I'll take over then. So this is going to be interesting because I'm trying to do about 10 things at once here. What I want to do with this particular segment is give you just a quick 30-second overview of our platform, because this is going to be the Submyt dashboard. The reason we're doing this, we're not doing this to kind of sell the product to you or anything like that. It is simply that this is going to be the easiest way for us to bring to life the theory that Dave has just been going through. We're going to see not quite real life scenarios, because some of these are fictitious numbers, but you'll see it kind of play out in a more kind of real and relatable way in this particular segment. So
yeah,
with that,
it's a really nice. That's a really nice way of saying we're not showing you our trading accounts, and you're definitely not seeing our tax reports.
or any of our customers. So if there's any customers watching,
God,
don't worry.
No.
Don't worry. This is not your data. Okay.
No,
Right.
we've test accounts.
So this is actually my test account, and we have a number of different scenarios here. So let me just kind of put this up full screen. Actually, I think that'll probably be easiest. Right. Okay. So quick orientation of the backend kind of Submit platform, just to kind of just so you can see what we're dealing with here. Once you get logged in your customer hours, you get a number of tabs on the side here. From account, where you get basic account details, get it started, which is an overview of everything that is, how to kind of hit the ground running with Submit. This transactions tab, which is kind of like the main kind of workhorse of the entire system, and we'll tap into that in a minute. Capital gains, this is where you actually calculate your gains, and everything is displayed for you. A few different things there, which we'll briefly talk about. Resources tab, so if you have any questions, you can often get all your answers here, whether that be related to how does CGT work, what are the filing deadlines, and all this type of stuff. This is all covered for you here. We have a referral program, and we'll touch on that. And then we've just got some of the things that are on our roadmap, which we'll touch on later as well. So this is just a kind of general quick orientation. Within the platform itself, this is the kind of the main area that we're talking about. In this particular scenario, we have a number of kind of assets that I've kind of put some shares in on. It gives us a complete portfolio value. So if you're trading across different platforms, it's nice to have that kind of single view of what your entire portfolio is worth. And then we've got that kind of broken out at the currency level as well. Then this here is the section where you kind of see all your assets and all of your trades. So all of these sections here are expandable. So for instance, and we're going to be talking to start with about our PayPal shares. I said, both Dave and I used to work for PayPal, so we want to we're just using that as a reference here. So in the PayPal assets here, you can see right now I've entered a number of trades, and I'll enter a couple more as we go through this conversation, but I just want to kind of set the scene with what this looks like. So let's go back in time for this particular one. Again, this is kind of loosely mapped to the PayPal kind of vesting schedule. So it'll be useful for anybody, any PayPal employees out there watching this. But what we've got here, we've got a performance share vest on 15th of April, 30 shares. And if you look over here in this section, this is our details panel. So we give you more details in relation to this kind of general transaction. So what we have here is we have 30 shares purchased, a price per share, again, quite fictitious, although it was strangely similar to what the actual price was back then. $75. Yep, $75. And just to kind of reiterate the piece that we were talking about before, in and around the currency rates. So if you were there doing this stuff on a spreadsheet yourself, you would then have to be going into what was the exchange rate on the 15th of April, 15th of February, 2025, taking out 2,250 US dollars and kind of applying the FX rate onto that. We do all that for you automatically as part of the system. So you can see that on that date, the applicable, let me kind of zoom in a little bit here, hopefully you can see that. So the applicable rate was 1.04487 or whatever it was, which gives you an actual euro value of 2,147.36. That's the actual currency conversion rate on that day for that particular trade. Further into kind of just the trade history for this example, we've got some RSUs that vested on the 1st of March, 50 vested and fictitious price per share at $80, $4,000 total, which in our euro conversion again is 3,842 and change. Then we're going to talk a little bit about the ESPP. So if you'll notice on this here, I've broken this down, and as you go to add events, whether that be acquisition or sale, you can put in things like type and type like in this one ESPP, RSU, PSU, stocks, that type of thing. That's merely for your reference, not for our reference. We still take all of this stuff and apply we basically put these as acquisition events as ordinary shares, and we apply all the rules and stuff that we've been talking about throughout this. But the type is for your reference only, and when you kind of download, so you can download your history and CSV files and all that type of stuff, that's kind of going to help you kind of marry a couple of different things together. So that's why we do this. But importantly,
sorry,
yeah.
Just to jump in, we are through this portfolio tab. You'll see at the top that there's a portfolio value, so we can see the various trading houses every time you log on. So we run a scan against those trading houses to reprice the current assets that you hold. So you'll always have visibility of your current current gross value, gross worth on the portfolio value. And I don't mean to distract us from what you're trying to talk about, Ian, but the way in which we're able to determine what I said earlier on about PayPal on the NASDAQ versus PayPal UK on the London Stock Exchange is through those asset types, and we match those assets as you add them into it. So that's how we know that they're ordinary shares, and that's why it doesn't make a difference if it's RSU, ESPP, or whatever. Yeah,
and you're right. So that current price, that 67.06, that is the actual closing price of PayPal yesterday. We run a daily check or twice daily check on all current asset prices. So in our scenario, we've got 80 sellable shares, and the actual current price of PayPal is 67.06 at yesterday's closing. The same way these are accurate for Nvidia and Microsoft that we'll get into in a minute. But I think the reason why I wanted to kind of show this one here, so we've got these kind of couple of acquisition events, right? We've got a 30, a 50, and a 15. In our trading platform, E-Trade or wherever that's going to be, these all show us different. And what we're simulating here is that we've bought some ESPP on the 30th of May, and we've later in our trading platform, we've later sold those ESPP. That ESPP lot we've sold. So you can take a look here. This was on the 1st of September. We sold those 15. So this is what you would experience on your trading platform. However, as we've been talking about before within the context of this conversation and revenue requirements, that's not how you calculate it. So and what we're talking about now is you're talking about things like FIFO kicking in. So if you remember Dave talking about FIFO, whereby it is the first in, first out, this is the rules that we have to apply in this particular scenario. So just because on E-Trade we sold 15 ESPP, the reality is that we were still held 30 shares from our PSUs that vested in February. We still had 50 shares from the RSU in March, and we've still got those ESPP from May. So when it comes to calculate your cost basis of this sell event, we don't look at what the ESPP that we bought for, which in this scenario is $90. Instead, what we have to do is we have to look at the original, the oldest lots that we have, apply the first in, first out rule, and then take those 15 shares from this 30 acquisition event in February. So in our particular sell event here, we have now sold these, again, completely fictitiously, for $95. And the PSU value, what we bought originally, was $75. So that's what we should be calculating that's how we should be allocating and calculating our cost basis. It's on these original shares that we had available in our portfolio. So in this particular scenario, and again, we have a lot more details now on the details panel because we've got a couple of different things going on. So we have the sell event. So we sold 15 shares, sold them for $95 each on the 1st of September. And again, we have to apply our currency conversion rate. So the cost basis of that in euros on the date of sale, given the exchange rate, was 1,216. So we then have to figure out, well, what was the cost basis of the acquisition of those 15 shares, factoring in the FIFO allocations. So in this particular scenario, and we have this kind of useful little tool here called View Purchase Lot Details. So if I open that up, you're going to get a pop-up load up now. And what you're going to see here is that we allocated 15 shares on this particular sell date, and the original transaction that we're taking them from was this buy event or this acquisition event on the 15th of February 2025. That complete transaction was 2,147.36 based on the 30 share acquisition. So now as we apply our 15 sales, it is now half of that. So what was the cost of those 15 shares that we sold within the context of that original acquisition event? So those 15 shares would have cost us 1,073.68. So that now becomes our cost basis for this particular transaction, rather than looking at the ESPP acquisition event that we were just talking about before. So that means our cost basis is 1,073. Our sell value was 1,216, which gives us a total net gain of €142.71. Now that would have been very different if we'd have made that sale within 28 days, because then the LIFO would have kicked in, as opposed to us having to apply the FIFO ruling that we have now. So let me kind of just demonstrate what LIFO looks like in this particular scenario. So what I'm going to do is I'm going to add a new transaction, and you can see here we have 80 sellable shares. I'm going to add some transactions here. I'm going to map it against this event, this RSU event that took place on the 1st of March rather. So this is how we add a transaction in this one. So as Dave was talking about now, we always find out which exchange that you're on. You will select it, usually based on ticker is the best way to do it. And then you can see that we're selecting PayPal Holdings on the NASDAQ, and that's the same one that we've been inserting throughout all of this. We're going to sell some RSUs. Again, that's just for your reference, really, not in terms of revenue. We're going to sell them on the 5th of March 2025. We're going to do it in US dollars. Number of shares, I think we'll sell 25, it doesn't make any difference. I can't remember what I had the price per share at. I think we had it at 80, so we'll put it at 100 just to make the math simple. And we're going to add the transaction. So now what you can see here is we've got this vest event here, as we spoke about, on the 1st of March. But then we have this sell event that kicked in on the 5th of March. Now, this is where we're kind of talking about the exception to the rule. So if you remember from Dave earlier, we were talking about if shares are sold within 28 days of being bought, then we apply a last in, first out rather than a first in, first out. So go back to our original example that we were talking about here. If you remember on that original sell of 15 event, we had used up 15 shares from that from the February acquisition event, which means that's 15 left over. However, because in this scenario here, we purchased these shares we sold these shares within 28 days of acquiring them. We now map these particular shares to this particular acquisition event because it's within 28 days. So again, if we go back here now and start looking at our purchase lot information, you will see that the 25 shares that we sold, the original transaction that it's mapped to was that acquisition event on the 1st of March 2025, where we had received 50 shares. And then you can kind of see that the allocation method that was applied was LIFO in this particular scenario, last in, first out. And then we can kind of apply, how many shares are remaining, how many shares were used and allocated to this particular sell event, how many are remaining, and this is where the purchase value of that particular event kind of kicks in. So, as you kind of break this down here, this is the acquisition cost, 1,921. This is in euros again, because we have to make sure that everything is calculated in euros, not in US dollars, even though that was how we bought them. And then this is the euro value of what was sold, 2,337, again, accurate exchange rate on the day. And this becomes our net gain, 416.71. So if you think about this particular example now, we have 55 shares remaining here to sell. But how do we make that up, right? So if you think about, we now have 15 left of this particular one here, and then we also have, I think, 25 left of this one here, and then we've still got 15 left of this ESPP transaction here. So that's what makes up our 55. So now let's try and think how complex that would try to be in Excel, where you've got to kind of go and scratch off how many shares have been used and allocated, how many remain per transaction, and all that type of stuff. This is where it gets complicated. Again, we're only talking 5 transactions here, and we've got 3 different share remaining events that we need to kind of capture and be mindful of. This is where it gets complex. Again, it's not the rules are somewhat simple, but it's the math that becomes hard.
The problem becomes compounded where it's very human to be very diligent and follow this as you do your trading through your Excel sheets and so on and so forth. But it's so easy to forget that you sold something within 28 days of acquiring it, and therefore matching rule applies. And that can cascade throughout the entire math throughout your calculations to date. And that's the biggest challenge that I think people face when they try to do this themselves. Excel is just not flexible enough, and I'm an Excel reformist. I have years and years and years of Excel calculations done. If I forgot one thing, you've to start again. Painful.
Yeah, and I think the challenge with this stuff as well is I had a point and I forgot the point. I was too busy transitioning slides and I forgot what I was going to say. Oh, sorry, I remember now. Right, so and this is so if you think about our system here, and the reason, just to kind of reiterate what Dave was just saying, every single time you add a transaction or you delete a transaction, we have to recalculate your entire transaction history within that particular asset, because every single kind of event has knock-on effects before and after and all the way down the line. So that is part of the complexity here, is that if you make one mistake, that it just compounds over time. So right.
I think it's important to note as well that this isn't an AI tool. What is AI? But this isn't like a ChatGPT agent running in the background around that. These are hard-coded tax rules that are in our Steam tool. And I'm going to put you on the spot, Ian. What does Steam stand for?
Oh, we calculated this. So Steam is Submit Tax Engine Automated Matrix. We liked the idea of Steam because we like the idea of being a tax engine and and all that type of stuff. So we had to retrofit an acronym to match Steam. So we kind of come up with that one.
Yeah,
but I think
that's the thing. We initially started with an Excel idea, trying to make it work because that's what we knew at the time. And then once we started doing FIFO, and then we were discovering other parts and the nuances of trying to serve a wider market and stuff. We were just software has to be software. There's no way of doing it. And listen, we've all used AI. We know it hallucinates. We know it creates realities for itself that don't exist. We don't trust it from that perspective. Certainly not with people's tax affairs. So the Steam engine is fully hard-coded, sits on a server. It's not agentic or in any way self-aware or anything like that. It's nothing to do with any of that nonsense.
And just to kind of reassure people of the complexity, if you weren't already aware of that or had doubts, in order to make this come to life, I think if I'm not wrong, I think we've got 15 different databases that kind of build that kind of all this data is sat on that, all has to work and operate together to kind of make sure that everything works and is allocated correctly. So it gets quite complex very quickly. But anyway, I'm conscious of time, so I'm going to take a look at Ross sales or bed and breakfast in rule, Dave, unless you had anything else to add to FIFO.
No, far away.
Good.
Far away.
All right, cool. So we're going to go into bed and breakfast in rule. In this particular scenario, I've used Microsoft. I'm just kind of simulating somebody trading on Trading 212 or something like that. It's just a euro one. I haven't put currency conversions in there, but obviously you've seen that, that's all handled here in the complexity of doing that. In this particular scenario, I've just got to buy and sell. I'm going to add in. I'm going to show you adding in what the event itself in a minute. So what you get here in this particular scenario, we've got 1st of March, we bought 50 shares, 7,500 euros is the total cost of that. which came in at 150 euros per share. We're simulating that Microsoft had a bit of a rough couple of months, and by July 1st, their price per share was 100 euros. So we're actually, a total value of that was 5,000 euros, meaning we've got a 2,500 euro loss on that particular sell event. Now, I'm just going to switch over quickly now to the capital gains tab. So there's a couple of acquisition events as we've seen here. So we've made some gains here. But what you can see here in this Microsoft one is that you can see right now that 2,500 euro loss is being allocated to the rest of the gains that we have had in that particular year. Because right now we've only just got an acquisition and disposal. We haven't applied our bed and breakfast or our deferred loss transaction yet. So that 2,500 has been completely allowed to be used throughout all the gains that are available within the course of that particular year. And we'll come onto this tab in a second, but so that's that one. So now we're going to simulate what would happen if you were to, kind of rebuy Microsoft within 28 days, because remember that 28 days is what is applicable for the bed and breakfast rule. And it's a different 28 days to LIFO, but it is 28 days nevertheless. So what we're going to do is we're going to rebuy Microsoft. I remember the ticker. SFT. Okay. Microsoft. We're going to rebuy. We're going to buy stocks, and we're going to rebuy them on, say, the 15th of 7th, 2025. Currency euros, number of shares. What we did. Let's say we bought. I want to keep the math simple here. Let's say we bought. Let's just say we bought all 50. Probably be easier. Price per share, let's say 120. Doesn't it?
And sorry if anyone from Microsoft is watching this. We know your stock's a lot more valuable than that. We're just keeping it simple.
Yeah, I realised after I'd added it, and it kind of told me that the current value was 517. I was like, oh, I was a little way off with my estimate there. Okay, so in this particular event now, obviously you can see this rebuy has happened, and this rebuy has taken place within 28 days of a loss disposal, when we sold an asset at a loss, meaning that 2,500 has been effectively cannot be used for losses within the course of the year. It can only be used within the sell event or the resale of this reacquisition event. So it's tied to this buy event exclusively. So within our system, as you can see on here, we rebought here for 120. This was the price. And you have the deferred loss deferral information. So we have deferred a deferred loss of 2,500 euros.
But if you switch over to full screen there, I don't think we're capturing.
Okay, that's a good share. Okay.
There you are.
So I told you about this multitasking lark.
Yeah.
Okay, so in this particular scenario, as I said, this is the details panel on the right-hand side, and you can see that we acquired them for 120 euros, but this 2,500 euro loss, which took place here, has been deferred and can only be used and offset against any gains of this buy activity. So then, if you take a look at the capital gains tab at this point in time, what you will see here, if you remember before that I did this, the total 2,500 euros was being used against all of the other gains that were on, and we had a subtotal like minus 800 or something like that, if I remember correctly. In this particular scenario, now what you see is this loss event has not impacted the overall running total of our gains because it's been withheld, because it can only be applied to that particular buy event. So in this particular scenario, you can see here that deferred loss is 2,500. The usable loss, as in what we can offset the gains on at this point in time, is 0. We can't use it because it's been tied to that sell event. To that reacquisition event. And you can see that has impacted our running total here. So this is really where it kind of comes in and takes place. So what I'm going to do for the purpose of illustration is just kind of see this through to the next one. I'm going to just pretend that we sold these. I'm going to sell them a massive gain just because it's going to make it a little bit easier to talk about. So Microsoft, we're going to sell.
Current price is $521.
Let's do 500 and let's do 500 euros. Okay, so transaction date is going to be, let's say it was a couple of days ago, 25th of the 9th, 2025. Euros, number of shares 50, price per share 500. Why not? I had a good run of things over the last couple of months. So now you can see here that we bought these shares at 6,000 and we sold them at 25,000, but which gives you a total gain of 19,000. But we were able to now apply that deferred loss of 2,500 euros that we had accrued prior, and then that kind of affects our net gain or loss from this particular transaction down to 16,500. So that 2,500 has been allocated to the gains of this particular transaction. And again, if we come into the capital gains tab, you can kind of see now this event here, 16,500 gain is what we've been applying, because the 19,000 is no longer applicable. We've only the gain amount is 16,500 because we've taken off that 2,500 that we had before. Now, just one final thing on this before we kind of start talking about other different things. It is important to note that when you're talking about deferred losses and bed and breakfast and rules, if there's an overage, so let's say for instance I sold this particular transaction here, and there wasn't a gain, I can't. That 2,500 euros is gone. I cannot allocate it to anything else. It is tied exclusively to that sell event. And if I don't make enough within that sell event to offset all of that gain, I lose whatever I've not used up. So it is important just to note that. And again, this sounds like we're talking professional traders and all that type of stuff. We're not. We're talking about people who inadvertently can fall into this stuff just by vesting schedules and that type of stuff. And it's really important that you understand how that all works. Now, the good news is, as is often the case, as what we're going to talk about here is, for the sake of 60 quid a year, we do all that stuff for you. So yes, this is really complex and can get really challenging. The good news is that you now have a software solution that's going to handle this for you. So that's it on bed and breakfast. And Dave, anything to add just quickly before I go on to a couple of other things?
Nope, fire away. All good. Okay,
right. So what I want to do now, just quickly, I'm not going to go through this in too much detail, but I just want to talk about a couple of other things. If you know about this stuff, you know about it. If you don't, you don't. Sounds silly, but stock splits. If one thing that has takes place recently, and actually a late edition. Thank you to Philip, you know who you are, for helping us spot this one. It was an initial gap that we had, but we've since implemented it. And stock splits are where a company will, Dave, you can explain stock splits better than I can probably.
Okay, sure, yeah, on the spot. So Microsoft, we've just talked about, right? Microsoft's current price is around the $520 per share mark, as listed on the NASDAQ. And sometimes companies want to split their stocks, either a reverse split or a split, to achieve various things. You find companies. So one of the rules of the NASDAQ is that your company price per share must be over X amount of dollars. I think it's $1 or something like that. Problem is, small companies don't get enough investment interest, and so they tend to tip down underneath that level. And the only way for them to do it is to do a buyback, right? So in order for them to buy back stock, they need to swallow up a load of market share, and then redo the price and take those shares out of existence. So shares, in essence, are 1 million shares are out there in the world and they're priced at X. Okay, I want to put 10 million shares out there, and because I've now 10x'd the amount of shares that are available to buy for the public, well, that needs to be brought down in terms of price. So if Microsoft is worth $520, it's now worth $52 because there's an extra 10x of volume that's open for the public to spend. It's simple supply demand. That's what it is.
Yeah, and I mean, all you need to really know is, firstly, we got you covered. We apply stock splits to this one. So the big one that kind of came up, and the reason why we kind of prioritize this one is that NVIDIA actually went through a stock split last year, in June of last year. They went through a 10-to-1 stock split. excuse me. So in this particular scenario, what you're seeing is we bought NVIDIA stock. We bought 10 NVIDIA stock at, I think I put in $1,000 per share, which I don't know how, whatever. 10 shares, and then whatever. It went through a 10-to-1 stock split in June 2024, which means that our 10 shares became 100 shares, but our cost basis has reduced by 10x as well. So that $1,000 price per share has now become $100 price per share. So we kind of calculate and capture all that stuff for you automatically. You don't have to worry about any of that stuff. So in this particular scenario here, you can see that even though I bought 10 shares here, I was able to then sell 50 on because they've gone through that 10x factor. And I've still got 50 left over because I've only sold half of my current holdings. And again, we take care of all that stuff for you, but I just want to kind of call it out to say that that's on there. You don't have to worry. It applies to all of our. It doesn't matter if we're applying FIFO, LIFO, better breakfast rules. We factor in stock split throughout all that type of stuff. So good luck doing that in your Excel spreadsheet as well.
Yeah, and generally you're only aware of it because you look in your trading account someday and think that you've lost 90% of your portfolio value, and you have a little freak out, and then you go into trading view and see the little S, and you're like, oh thank God, it's all fine.
Okay, so I think that's kind of it in terms of the rules themselves. I just want to give it a quick 30 seconds just on, again, a bit of a kind of, not sales pitch, but value propositions, I suppose, of the solution that we have. So one of the things, and I'll transition to full screen mode here, one of the things that we have found in our experience, particularly if you're dealing with a tax professional, or particularly if you're trying to self-serve and that type of stuff, is that it's very hard to know where you stand at any moment in time. It's very hard to budget and kind of allocate funds. So you make a big sale of RSUs or on stocks or whatever it is, you know there's a gain for it, but you don't know how much you owe, what your current liabilities are, and that type of stuff. And that becomes really challenging and complex to kind of navigate. So, one of the beauties of our particular platform, and again, a bit of a kind of our value propositions is that we show you, if you keep your trades up to date on the platform, we show you in real time exactly what your liabilities are based on your activity at any one point in time. So right now, again, this is completely fictitious numbers when we had that really big sell event in Microsoft that we just simulated. But right now, based on that activity, I could turn around and go, right, I've just sold all this kind of stuff. I know right now that I have a capital gains obligation of just under €6,000, and I'm calculating that based on what was my total gain, taking off my allowance, then applying my 33% to give me what my total gain is, and I can see then what is owed per period right here. So I can turn around quite easily and say, right, I just made this big thing. I'm going to take, nearly $6,000. I'm going to stick it in another bank account. I'm going to put it out of the way. Then I know that when it comes to paying my capital gains tax in December for my period one allocation, I haven't got to go freaking struggling to find the cash or worrying about what that is. But I think the other thing that is important to note here is that if you're using a tax professional, now obviously, again, we're not dissing tax professionals or accountants, that they're very valuable for what they do. But the challenge with that is that oftentimes it's a transactional relationship. So you're interacting them with the what's per year, typically for filing. At that point, you've already missed two of your deadlines for paying your obligations, and you're already accruing a penalty or an interest on the gains that you've made because you haven't filed with it, because you haven't paid within the timeline that revenue dictate. So this is the very reason why we actually have a full tax solution. The very reason we have a subscription service is to give you that year-round support, because you need support multiple times throughout the year, not just a one-off event in a very kind of transactional way. So that's kind of the beauty of one of the reasons why we built the system the way that we have. Okay, so I think that's kind of it as a kind of 101 for or an overview of the system and how it works. I might just, if it's okay, if I got 2 seconds, Dave, just touch on a couple of other things up and coming and stuff, if that's okay.
Go ahead.
Okay, cool. So a couple of different things. And as I said, we have these kind of resources. One of the things that we have a referral program built into it. So every single customer of ours, and even if you're not an actual customer, even if you're somebody who is just interested in it and sign up for what we call a discover account. So whether it is you're interested in kind of testing it yourself, or whether you just want to become an affiliate almost and kind of refer this out to friends, that type of stuff, you can sign up for a discover account or participate in our referral program. What that basically means is you'll see, if I share my main screen again, you'll see in the dashboard you have this referral program here. You have a link to your referral area, and within your referral area, this is what it brings you up to here. And you get your own unique link that you send to people. And for anybody who signs up to a paid plan from your unique link, we will happily give you 20 euros for that introduction. At the end of the day, we want to help as many people as we can, and the more people that you can introduce us to, the better. And so we will happily compensate you for that introduction. I think the only other thing then, just to kind of talk about then on the system itself, is just maybe what's coming up soon. You've obviously seen the system itself is very kind of comprehensive as it is, but there's definitely more add-ons that we want to do. I already spoke about kind of ETFs and building that out. That's one thing that we want to do. Another thing that we want to look at is kind of file uploads to make that kind of addition of or the adding of trades more seamless. We potentially want to look at API into Trade 212, so you just connect to your account. That's something that's on our roadmap. And then maybe even private company shares as well, because obviously right now we're only very much dealing with kind of publicly listed companies, but we want to kind of bring that into the more kind of private company shares, thinking of the likes of Stripe, Revolut being two big examples of private companies, and we know that there are share schemes available within that as well. And then I think that's kind of it as a general overview. I think one last thing just to finish up on, obviously we have done this now. We as we've said, we have 30 years experience between us in the corporate world, and one thing that we found is that it was very hard to get the education that we need that was relevant to people within the corporate industry. I think that's the key point. I think a lot of people know the rules, but making it relevant to people who receive equity-based compensation was really difficult. And we found that, I suppose, very frustrating. So we do also have an employer program. So basically, you'll get a much shorter version of what we've just done, but very much dedicated to the employer. So if you are in a large company and you want us to come in and talk to this and kind of talk specific to your individual company equity plan, we can do that. We're happy to do that. And we can easily kind of do this kind of presentation within 60 minutes. We obviously went a little bit more in depth in this particular one, just because it was a much more comprehensive overview. So we have that employer program as well. Details on the website, I'm sure you can find them if you were looking for it. I think that with that, Dave, I think that's me.
Thank you very much, sir. Just to go back on one thing, and I promise you it's not a rant, we're way over time, but
Good. It's fine.
We've been in those sessions before. I remember one specifically where I'm going to go into income tax here a little bit. And for the record, we don't touch income tax, folks. We're CGT only. As Ian always says, we're staying in our lane. But
For now.
For now, yes. Well, we've enough on the roadmap for now. So, but I remember maybe 300-400 people in the room, maybe a bit less, and lots more online. And a large accountancy firm had come in to talk to us about our plans, but clearly didn't know anything about our RSUs or PSUs or ESPPs. They had no idea. They understand that the larger holistic version, kind of similar to what we talked about here. But I remember at one point, somebody asked the question a lot of us were thinking was, what's the story with this discount stuff? I heard we have to pay income tax on it. And the accountant turned around and said, yeah, of course you do. You have to file an RTSO 1 form and you have to pay them within 35 days or XYZ will happen to you. Kevin from Revenue will come and kneecap you if you don't do it, kind of stuff. And when you're in a room and the entire mood changes, like it just happened. And then very quickly turned into a bit of a rabble kind of crowd. And I remember talking to a few people as we were leaving, and genuine worry, genuinely terrified that people have been out of compliance. And to touch on the employer program a little bit, I mean, your tax affairs are your problem. Yes, you are impacted by the decisions the company made to reward you with equity, right? Stocks, shares, whatever. But it isn't up to them to sort out your tax affairs in the same way in which it's not their job to sort out your tax affairs on your income, right? They'll tell you call revenue. And so to go back to the kind of the start of this is that what we're hoping to achieve is to empower you guys and give you the tools to be confident in doing this yourselves, and never find yourself in a position like you're in that meeting with the tax company and it being all wrong. Or indeed, we're standing in front of you someday in Apple, Microsoft, or PayPal. Give us a call. We'll happily stand in front of you to do it. But you might be the only person in the room that's comfortable because this is boring. I know all this stuff. Fantastic. That's mission complete for us. And like I said, we practice what we preach. We want people on the cheapest plans because we know the calculations are a nightmare. It took us a long time to build this thing to the stage it's at. And for considerably lower money than you'd pay for an account, you can get the Submyt platform. What Ian showed you is available in all our plans. There's no kind of special unlock features. There's no, oh, hey, it's 30 days to tax filing season. To unlock this feature, we can unlock FIFO for a 10. We don't do any of that bullshit. We just do 60 quid starting price per year, as many tax years you can go back as you want. We don't care. And if you're really, really, really stuck, and we really don't think you need it, but if you're really stuck, we are registered tax agents. We can file on your behalf with the revenue commissioners. But I'm not going to lie, and I've said this on some of the social media platforms, all we do is fill in the CG1 form for you based on the information that you put into the site. The tax reports that we give you, they basically tell you how to fill it in. So, you know, you're kind of paying for a step you don't need. But again, that's just, we felt it'd be the right thing to do, just to take it off people's hands if they're really super stressed out about it. So yeah, I just go back to the foundational basics of what we went through today. Think about it from an acquisition and disposal perspective. Remember the dates, they're the critical things. And if anything, they'll just kick you into gear to get things started. Try it with Excel if you're that kind of person who short trades very quickly or sells immediately. If you're an employee getting stocks, it's a lot easier for you. You probably get away with just doing an Excel sheet so long as you didn't miss one, because then all the FIFO stuff kicks in. I suppose the last thing for me is we'd love feedback. It's our first one. We are 45 minutes over. It's Ian's fault. And he's the director. No, you're the one controlling the studio, my friend. But we would like to do more of these for a couple of selfish reasons, but also a lot of non-selfish ones. We want to get as much of this kind of stuff out in plain English as we can. It's great for feeding our content channel, with our channels with content and stuff like that. We can chop them up and put them into shorts and all that kind of stuff. But fundamentally, we can't address what we don't know needs to be addressed. So if you tell us what's wrong, we'll happily have a look at it and create some content around it. And then finally, if you're kind of stuck and you go to the website and you're just like, Jesus, Davine, I don't know what to do. We have Discover accounts. They're completely free. We don't paywall you. The only thing we don't allow you to do is add too many transactions. So you can go in, you can play with up to 5 transactions. That's buys and sells together, just to get a feel for the system. But all the other stuff, like you mentioned earlier, like referral program, the contact us page and all that stuff, all of that's unlocked. So the only restriction on a Discover account is 5 transactions. That's it. And you can play with it. And if you're really stuck, set up a call. We love to talk to people. I love to talk. Trying to stop me is the problem. So if you go into the Getting Started tab after signing up for a Discover account, all the way over to Need Help, and you'll see a Calendly set up, and you just set up a time that suits you. And if the time slot is available to be booked, we're available to talk. So be our guest. If you really need some help, give us a shout. I will reiterate one more time, though, we are not qualified financial advisors. We are not tax accountants. We are tax advisors. We are not tax advisors, rather. We just are licensed to fulfill your tax obligations for you using a really, really smart piece of software that we built. That's it for me.
Yeah, I think just one final thing then, or two final things rather, just on that piece, but as you've kind of seen, the solution that we've built is very, very comprehensive. We've been through all the tax rules, the discovery journey that we went on. We've been doing this for well over 12 months at this point, kind of building all this thing out, and it is very comprehensive. It is very accurate. There's no issues with any of that type of stuff.
Tested the living hell out of it.
Really. Yeah, I think the only thing I just want to add, just for our crypto bros out there, because we didn't really get to speak to them or about them a little bit, is just that we do help and support with that. Now, we haven't built crypto into our solution right now. There is a third-party crypto tax calculator called Coinly we partner with. So if you do have either just crypto trades, or if you do have a mix of crypto and other kind of assets, then we have a solution out there for you. Actually, Coinly have just changed their pricing so that they now do a per annual cost, whereas because we partner with them in the capacity that we do, you get a Coinly license as part of our package, and that gives you access to all your tax years. It's not just at an annual level. So actually, there's a pretty good benefit to along there from the Coinly standpoint and get them the best value out of that. And then basically we help you, or we can show you how to take the data from Coinly, input it into our system so that everything matches together, works seamlessly. So happy with that.
Yeah. The Coinly licenses we get, fundamentally with our pricing model, it's the same. The price we pay for Coinly is just passed straight on to you. But I can't remember I think it was a €90 license or something like that was the private one needed to match the licensing we got, and the pricing for us is like €60. So, and I think the only other difference is you can add up to 25,000 transactions per tax year with our license, whereas it's capped at like something I can't remember. So it looks on the face of it to be the same thing. It ain't the same thing. But yeah, if you're a crypto bro, degen as Ian's talking like he's 17, then yeah, the Coinly licenses, it's actually a wicked piece of software. It really is. And we wish trading platforms for stocks and shares were as integratable as the Binances of this world are. The fact is, they're just not. Fun fact, we were told we'd need to set up an LLC in order for us to get an API key from a certain trading platform that shall remain nameless, that we've mentioned a few times on this call. But there's only one that has open access, which is Trading 212, which is where we're going to probably go first. For the casual traders or even the high frequency traders, you'll be able to import your data straight into it, just like a Coinly license would allow you to. That's coming on the short side of our roadmap.
Cool. All right. I think we've sufficiently exhausted our 60 minutes.
Yep, definitely. Just final thought is to say thank you for anybody who's watching this or anybody who joined us. We know your time is valuable, and we have grotesquely abused it if you're still here with us. So thank you very much. I'm very glad nothing went wrong. Dogs haven't gone mad. Power didn't go out. So things are looking pretty good. If this is a format people enjoy, please, for the love of God, let us know so we can schedule them out. What do we want to make them about, and make it part of our kind of our content strategy. Of course, feedback really, really welcome. But I suppose for me to finish off with and say is thank you for anybody who's watching this. Thank you for your interest in Submyt. We're new. We're trying to crack into a market that's not easy. And any support that you can give, even if it's a selfish support, like signing up for a Discover account and making some money, go ahead and do it. It's up to you. So thank you, everybody. Been a pleasure. Hasn't been as horrible as I thought it would be. So see you soon.
Thank you, everybody. Speak soon. Bye-bye.